Today, I want to welcome to the program Dr. Phil Moulton. He is the Director of Risk Management at Colfax Corporation. They are a global diversified technology company with over 25 years of services in internal audit, global insurance program management, enterprise risk management, business continuity, mergers and acquisitions, project management, and they do both consulting and corporate types of roles. Phil was born in Australia, and he and his family spent 8 years in Singapore before moving to the United States in 2011. So he recently completed his doctoral degree. So a big shout out to you, congratulations, at Wilmington University, and he successfully defended his dissertation, which is decision factors used in decision-making for cyber insurance by risk managers, which is what our topic is going to be today. And the study investigated the perspectives of 19 risk managers in the US in purchasing cyber insurance and the significant sources and methods they used in developing the policy limits. And Phil is going to run through his study for us, some key lessons learned, and then we'll open it up to Q&A. So Phil, welcome to the program.
Wonderful. Thank you, Ariel, and appreciate the opportunity. And yeah, I'm a big believer that research like this should be shared as broadly as possible. So I'm very grateful for this opportunity.
So why don't we start out? I know most people know what cyber insurance is, but I think, we don't know who's on the call. So it's always a good idea to start out with the basics. So what is cyber insurance?
Yeah, getting definitions right is usually the first step in any good research or discussion. So a basic explanation, if you really boil it down, is that a cyber insurance policy, like any other insurance policy, it's a legally enforceable contract that enables a company to transfer risk to an insurance company. From a customer's perspective, it's really what I'm doing is moving the downside risk of a fortuitous financial loss from cyber exposures as defined in cyber insurance policy. And I'm using the balance sheet of the insurance company to get the benefit of what's often termed as risk pooling. Essentially that insurance companies are far more efficient in taking risks from various organizations, pooling them, and being able to generate profits from that. So it's I think more broadly, if you sort of zoom out a little bit, it's really an important part of any cyber risk management program, in that it should reflect what you have as an organization with your IT security program, with your broader cyber risk management efforts.
So what we're teaching in our PACE course about cyber insurance is that it's part of a strategy, that we want to ensure that you're not just looking at people, process, and tools in cybersecurity and understanding it from the business perspective. You need to have a strategy around cybersecurity. One of the strategies is the limits, and there's other things like a ransomware strategy, which is important. And what we're seeing is that about 1 in 10 have adequate limits, and the rest of them are very, very far off in terms of their needs. And so this is a fairly new industry that has sprung up out of property and casualty. And I don't know what you're seeing, but what I'm seeing is that a lot of insurance companies want to treat cybersecurity like property and casualty, and there's not a lot of congruency there.
No, absolutely. And a couple of points that you raise are interesting. While the study did not look at the extent to which cyber cover is underutilized, and you mentioned it, 1 in 10, what you're seeing is 1 in 10 are underinsured. There's a couple of good research studies which fortify that idea, that compared to property and casualty, the amount of cyber losses an organization face far exceeds whatever insurance program they have in place. And it's also a very new, very novel form of insurance. I mean, essentially, it's only been around for 20 years since the early 2000s, probably leading up to Y2K and that whole time when we were very concerned that airplanes would fall out of the sky on January 1, 2000, and if you remember that, and sort of leading up to that. Although there was one study which drew back to 91, 92, which picked up a warranty policy for a hardware provider, which had some insurance type language and contemplated business interruption loss. So that's a bit of a fun fact for you, that perhaps cyber insurance is more like 30 years old as opposed to 20. But regardless, it's a very new form of insurance, considering property insurance has been around for more than 100 years. Cargo insurance has been around since the late 1600s, since Lloyd's coffee shop established itself in London. So I would think it's fair to say that as an industry, we're all learning. There's a few things that need to be in place for risk to be efficiently transferred, such as lost data. It's really, we've only got about 5 to 6, 7 years of lost data through net diligence is one source, and there's other global databases which map out cyber losses as well. I think the other thing too is that it's a very complex risk. It's unlike property and other types of risks, it's continually evolving. What is this year's major loss is going to be different to next year's major loss when it comes to cyber. With property, it's fairly well known. It's your natural catastrophes, it's your fire, flood, tornado type of losses. And these things have been studied and catalogued in various benchmarking and databases around the world for decades now. So we're still at the very early stages of the cyber insurance market for sure.
Exactly. And I think that as we see it evolving, and we compare it to property and casualty, just for one more kind of interesting point, is that the actuarial data that they use is based on incidents that have happened in property and casualty. Like, we know that 16-year-olds who drive Ferraris have a high likelihood of an accident, right? And we know if you live in Tornado Alley that you have a high likelihood of getting hit with a tornado, perhaps. So it's very different in cybersecurity. It's not, if you had a breach last year, you're going to have a breach. It's not like that at all. So we don't have the same kind of benchmarking that they do. And to your point, you said earlier, it's evolving based upon, the flavor of the month. And right now we're looking at SolarWinds and the fact that the insurance market is starting to harden, and it was starting to harden before SolarWinds. And now it's hardening more around ransomware coverage. And so this is going to get really important for people to get right. And I'm glad that you took this as your dissertation topic, because it's interesting. So what made you decide on this topic? How did you get interested in it?
Well, two things. I've always been interested in IT and cyber risk management, and I've done some IT security auditing, and back 20 years ago in my time in the Big Four and Protiviti, and having switched over to corporate risk management roles in about 10 years ago, I began to become more exposed to cyber insurance. And it was first presented to me back in 2013 in London in a conversation with our brokers at the time. And I thought the coverage at the time was very underwhelming. It really did not meet our needs. And and I was working for a chemical manufacturer at the time. And as it became, I kept in touch with those brokers, and into my new role, I saw cyber insurance really started to evolve and become more relevant for an organization, any organization, frankly. At the same time, that if you look back the last 7 or 8 years, we've seen new forms of crime and losses emerge, and a lot of these losses are well documented in Ponemon Institute and the Net Diligence Cyberclaim Study. So when I started to think about, what my dissertation will be for my doctorate program, cyber insurance fit in quite well with my background knowledge and what I was professionally interested in. And I could see it as a societal problem. If we zoom right out, you think about the digital revolution since the 1980s, and as I started doing more reading and getting to my literature research, global computing power and capacities increased 50% between 86 and 2007. 50% year on year. I mean, this is quite extraordinary. And when you couple that with all of the losses that emerged, you can see that this is a massive problem. And that's one of the reasons why you see folks like the World Economic Forum, putting cyber risk alongside climate change as one of the biggest risks facing us, facing our societies and us living living here on this earth. And one other thing too, that the Ponemon Institute, and they've done a sterling job of mapping these losses the past 10 years or so, and their methodology seems to be quite rigorous, is that in 2019, their paper came out with what was the first time the losses beginning with a T. So they were estimating $5 trillion of losses over 5 years. And that was the first time I saw a study with a $1 trillion number. And those attacks are increasing in the low double digits year on year. And I can't help that, when fast forward from a year from now, we're going to be looking at all of these numbers and saying, well, they were actually underestimates. So you see a lot of these. So what really interested me was, the overall risk. As a risk management professional, I'm very, very keenly interested in anything which is an enterprise level type risk, and something which is very relevant for any organization. So that's why I steered towards cyber insurance as an area of study.
And you couple that with the fact that 85% of the business is now digital, and 20 years ago, 10% was. You're looking at the attack surface just is ginormous. We have the internet growth, we have the digital asset growth, we have the regulation growth, and all these things together are the perfect storm for cyber criminals to take advantage of companies that don't have insurance or have poor cyber hygiene. So, what did you find the most challenging about the topic? What was the hardest thing to understand?
Well, I think from an academic perspective, it was very difficult to get good quality peer-reviewed research papers and literature. It's probably because, once again, cyber insurance is so new. The expectation going into any dissertation or thesis for PhD students or doctorate students is that they would be able to gather several hundred papers of high quality peer review research. In the cyber insurance field, there was actually very little, and that became very readily apparent because you kept seeing the same authors being cited over and over again. So it's still it's a very niche, it's almost a niche of a niche area when it comes to an area of study. Because there's so little work or so little research available to me, what I found most challenging was to start from scratch almost in developing a working model to describe the boundaries of the research, because any research topic, you can't boil the ocean, right? So you need to set boundaries, identify what were the subject areas that were going to guide my areas of query and ultimately my interview instrument. On the other hand, what was most challenging about the topic was also made a little bit easier, is that because there was so little research done on this subject, relatively speaking, I had a great deal of confidence that whatever research design I came up with, it's highly likely to be original and new, which meets the criteria for any dissertation or thesis. And so, there'd be even less risk than normal that there'll be you're always very concerned about plagiarism, even unintentional plagiarism. So that was sort of the back of my mind, to say, well, the risk of that is even lower in cyber insurance than in most other subjects. So that provided some confidence for me going forward. So what was most challenging was also, you make lemonade out of lemons at times too.
That makes sense. So when we look at different industries, are we seeing differences? Are there things that we can point out that might help people who are in the financial services versus the e-commerce industries, as an example?
Yeah, so that was one of my my research question, apart from looking at determinants and what was driving the limits, was what did the risk managers see as some of the industry specific drivers? And this was a question that most risk managers struggled with. And I asked risk managers across 15 different industries, so it was a good spread of industries. Um, there was no significant results from the study's perspective, although they did identify some drivers around the extent to which sensitive data is being collected, and perhaps that would explain why there would be different approaches taken by different industries. And sensitive data, such as personal identifiable information, personal health information, credit card information, um, different industries will collect those to different extent, right? So financial services, health and medical systems will have a very different cyber risk profile than, say, a manufacturer. Will have a different profile to, say, a technology company. I think one thing which is also an implication from this as well is that different industries, it's not just the industry which will drive the need for cyber insurance. As I see it, is that as different industries look to get more out of a data-driven strategy and start collecting data and try to monetize that, even manufacturing companies are starting to collect data on their customers. So all of a sudden, you have an organizational strategy starting to change your cyber risk profile. And on the other hand, you've got health systems. One risk manager from a well-known player in the healthcare industry explained that they have lakes of data of PHI and PII, and even then, that was going to multiply exponentially as they started to expand into telehealth and starting to do their medical trials digitally. In other words, they'll do medical research with with wearable health devices. So you can imagine that the kind of personal health information they're going to be collecting when they start rolling that out. So it's not just industry, but also strategy, which is really driving changes in cyber risk profile, and therefore looking at changes and a greater need for cyber risk management and cyber insurance. I think privacy protection too, big issue for many industries, and that sort of tying the data together as well. And I think one final thing on industry, the level that the industry has to be global. So if you think about global companies, they tend to have a bigger attack surface. Talking about what you were saying before, Ariel, that they're decentralizing their presence across the world in order to get scale to grow. And some industries are like that. Then if they have decentralized IT systems, think about how that impacts their attack surface as well.
Exactly. So did you find the buyers to be different across different industries, and who was involved in the process? What different roles were people playing, and how is that either helping or hurting people in trying to figure this all out?
Yeah. Well, I spoke to 19 risk managers, and as we talked about the purchasing process, they would often say that they were driving it, but they also had input from executive management and the boards of directors. And the boards of directors, there seemed to be, there was, one significant finding was that the board of directors were either being informed or consulted on the decision to purchase cyber insurance. So this is now a board matter. CFOs are now have picked up the game as well and starting there to ask their risk managers about their cyber insurance and playing a bigger role in that. So I think there's, I think we're starting to see cyber insurance as not just being in the domain of risk managers, but getting into the sort of the whole governance domain within an organization. It makes sense too, right? Because as I said, this is an enterprise level risk. Boards of directors have fiduciary responsibilities around ensuring proper risk management of their organizations together with the CEO and the C-suite. So they will want to know to what extent after cyber risk management programs are being put in place, what kind of financial exposure are they facing as a residual risk, and how cyber insurance will help them reduce that risk even further.
Especially since Aon released a study a couple of years ago that said that D&O derivative actions are now, cyber insurance is the top, cyber risk is the top 3 triggers for the D&O derivative. So when we're seeing is that the board has to have an active role. And if they don't, then they're putting themselves at risk personally. One of the things that we've been looking at is the litigation data surrounding insurance claims and events, specifically either class action lawsuits, these D&O derivative actions, or also now the attorney generals are getting into the picture because they've got those privacy regulations. So you've got CCPA, so you've got the California Attorney General. And as everyone starts to evolve their privacy regulations, which is going to be in the next few years, we're going to see state by state adoption. So what are you seeing in terms of being able to address that aspect of it? Are people looking at it? If you look at Equifax as an example, their data breach was well over $5 billion. 1.4 billion of that was for the remediation piece, which was to notify the people, to do the forensics, the PR, and then the other 4+ billion are lawsuits. So, and fines from regulators. What are the thought processes around that the risk managers are wrapping their heads around?
Yeah. No, there obviously there's a lot of concerns about fines and penalties and third party, so often referred to as third party losses. What is interesting is that the cyber insurance product has broadened considerably the last 5-6 years to incorporate fines and penalties and even PR expenses and actions and lawsuits, etc. It'll be interesting to see how going forward, whether that coverage is going to continue or whether it's going to be limited through, say, co-insurance or being sub-limited. Insurance companies are extremely good at limiting their own risk exposure as well. So I think the concern is that do we have enough, and in terms of insurance coverage, and do we have sufficient coverage? One thing which came through the study very strongly amongst the risk managers is that they are fully cognizant of the need to understand their policy wording. Unlike other types of insurance policies, such as property or cargo or motor vehicle, cyber insurance policy wording differs quite a bit from insurer to insurer, and more so that you have sort of the coverage section which talks about here are the things that you'll be covered for, and then you'll have the exclusions and say that we might be covering you for this, we might be covering you for that. So what researchers show, and what also the risk managers were telling me, was that the degree of variation between carriers for the coverage section is not as great as the exclusion section. So risk managers need to focus very, very carefully on what is excluded from the policy, and to really examine and drill down into the wording on those exclusion paragraphs. And this is where, and it's one other key point too that came out of the study, was that it's critical for risk managers and others to work with a broker who is technically proficient at this area. This is not something, and this is a strong personal view which was reinforced through this study, and certainly not, I didn't bias my risk managers when I interviewed them on this, but then they came out with this by themselves, as saying that you really do need a broker who knows his or her stuff. And I'm very fortunate. I work with brokers who are ex-attorneys, so that they are sort of legally and technically minded, and they understand enough about IT security systems and the legal landscape as well, to give me good advice. And risk managers really implore others to make sure they have a very good broker.
So a couple of things.
Go ahead.
Just to follow up on your thoughts there, are New York State Department of Financial Services just released yesterday a framework for cyber insurance, and it stipulates quantification and how they're going to measure risk. And this is a big deal. And so we've already gotten into action on crafting a course around that so that people can know what the heck to do. Because it's an area, like you said, that it's not, unless you have a broker that really is technically savvy. And one of the issues I think that happens as they build the towers of insurance, which each carrier has their own language. So not everyone is speaking the same cyber speak, and that has to stop. You cannot call vulnerabilities a risk because they are not their vulnerability. And they have to get really clear on what the heck they're doing. And in the beginning, I think a lot of people didn't really understand cyber. Now I think it's much, much better, but we still have, gaps in the education of the brokers as well as the carriers. A question I had for you was about third parties and what's the predominant approach at this point? How are they understanding that, let's look at SolarWinds. Okay, what happened there, right? So first of all, most companies don't even know if they have SolarWinds Orient as a digital asset. So that's problem one, right?
Right.
Second problem is that when they did the risk assessment on SolarWinds, Orion, is they didn't understand what was really important in the assessment, right? So think about that. It's like, what does Orion do? It's a network and infrastructure management tool, right? So that means your entire infrastructure is at risk. So if they're updating you, wouldn't you want to make sure that the SSDLC actually was good?
Right.
I think this is where the everything falls apart for me with a lot of companies, is that they can't put the context around the third party, and they can't put the context in terms of what the digital asset does.
Right.
And we've got this gap. So kind of going back to my original question on the third party, what's their approach now? And are people understanding that it's not a checklist?
Right.
What are you seeing?
So let me answer that question, taking a sort of a different track. So I think what you're trying to get to is, how are we identifying what limits we need to buy? I think that's the ultimate question. And for me professionally, this is the most concerning area. And again, I was very careful not to bias the risk managers I interviewed. And I get on my soapbox on this. What we need professionally as a cyber insurance, a cyber risk management community, is to really push for the way the way OSHA and other regulatory agencies push the chemical industry 30, 40 years ago in process safety management methods, and PSM has improved safety incredibly in the chemical and petrochemical industry by making sure you're drilling down into those assets. What is that chemical vessel doing? What are the risks, specific risks associated with that vessel or that asset? Doing bow tie diagrams on that asset. That's the level that is expected in the chemical industry for them to pass muster and for them to have a license to operate. And that's probably 30, 40 years ago, well, probably even extending back into the 1950s and 60s. But where we are with cyber insurance in terms of determining limits is a very strong dependence on benchmarking. We all have, I'm sure many of us on the call understand the inherent weaknesses of using benchmarking, because that essentially just tells you what your peers are using, not essentially what you need. So I'm a big believer that if we are going to start to properly quantify the risk, we need to really decompose the risk into the most basic and meaningful level, which is, for me, digital assets, and to really start to work on those digital assets, just as those process safety managers started working on developing quantitative risk assessments on those chemical vessels and reactors and things, and their assets at that level. So about 80%, 15 out of 19 said benchmarking is what they use, and 14 out of 19 said that they use their broker recommendation. we have a long way to go to really mature in this area. And you know, and I was thinking last night, so I interviewed 19 risk managers for my research study. I did a pilot of about 10 risk managers before I got into my dissertation. I also spoke with about 8 or 9 subject matter experts. The only methodology that I heard for of a quantitative risk assessment method was the factor analysis of information risk, or FAIR model. That was mentioned by one person, one person out of 36 or 37 people.
Yeah, and the thing about FAIR is it doesn't quantify. So that person was incorrect also, because FAIR looks at vulnerabilities and likelihoods, right? So the only known method is digital asset. Right now, it's the only one that anybody has, the analyst community, the academic community. It's not well known, and that's one of the reasons why we're teaching it, is because the understanding isn't there. And it goes back to when you surveyed them, and 15 out of 19 were asking their broker. The broker needs to be a digital asset and cyber risk quantification expert, and they're not. So there's a huge disconnect, right?
And our current risk assessment methods are really failing us. If we are using risk matrices or 5x5 risk maps, even sort of basic scoring, there's a ton of academic research out there under decision science which has disproven a lot of these methods. And there's a big problem with these scores and scales, and the psychology research has shown that even interpretation of words of what is likely, what is unlikely, I mean, the interpretation of that word by different people is just all over the map in terms of trying to nail down a percentage of probability. And so that variation makes a lot of these risk models inherently unstable and unreliable. And even 5x5 risk maps have been shown to add new sources of error, scale compression, and even resulting in worse decision making. And this is all, again, backed up by high quality peer-reviewed research that has been out there. Doug Hubbard, who's written extensively on how to measure anything, and on cyber risk quantification, as well as the failure of risk management, makes this point very, very well. That really what we need to do is break the risk down into called decomposition to its most manageable part, and that enables you to do a proper risk assessment using scientific approaches. It may not be perfect, but at least it's a whole lot better than starting with red, yellow, green, and how if we invest in this, we're going to reduce our risk by that much.
Right. So the inherent risk scoring from a digital asset perspective is breaking it down into those components. And the question just came up on IoT. And when we think about, I don't know if anybody saw yesterday in Florida, they tried to poison the water supply with lye, and it was done through a IoT device. So we have a big disconnect again on, okay, so if you use IoT, one of the major issues is that they don't have any access control mechanisms built in, right? So wide open. So it's like, it's the number one rule in access control, that you don't have a default password in there, and you don't have a wide open access in there, right? And so but the organizations are buying these technologies without going through the security people on the security advisory board and saying, hey, is this okay? And they do that with their cloud services, and they do that with everything. And so the shift in the thinking to get companies to start to understand how to help themselves needs to start with education and getting them to get clear. So likelihood is an interesting topic. And I think that the gist of it is that there's likelihoods based on 3 different levels of information. There's likelihood that's based on the inherent risk of the asset. how many interfaces, how many people use it. There's likelihood after you do a security assessment that you've put mitigating controls in place that have reduced that risk, right? Because if you've done that correctly, that's what they're supposed to do. But then you've got the stuff that you haven't planned for, like, a new vulnerability, is 0 day that you're not ready to deal with, right? So that obviously makes your likelihood off the charts. So the dynamic nature of cyber doesn't lend itself well to the old mentality of the insurance industry. So just a final thought before we go into questions. What do you think the areas of further research need to be here? What would you like to do next if you had the ability to go back and do some more research?
Well, I think I'll answer your second point first. So I think I really would have loved to drill down further into what specific laws and regulations were driving the insurance purchasing. I suspect I know, but it would be nice to confirm whether it's privacy or GDPR or what else is out there. Risk managers also really value the pre-breach and post-breach services that are allowed now under many cyber insurance policies that are now on offer. A friend of mine, Daniel Woods, has got a nice workshop about 12 noon Eastern time, where he talks about the ecosystem on post-breach services under cyber insurance policy. So he's be talking about his results and gathering some information from the workshop. Yeah, I would really love to see. I think the next step is really to how do we make cyber risk quantification more accessible to a broader range of people? Because for me, that is the sort of the desperate need, and to really try and we almost need to evangelize that, I think, much more strongly, and to get people off benchmarking and recommendations and using very unscientific qualitative methods to assessing risk.
I could not agree more. Yes, absolutely. So let's move to some questions. Sean, thank you very much. Sean is saying that he's seeing, in terms of limits, especially as it relates to segments like ransomware and fraudulent transfer, is that the carriers are starting to drop those limits and lower the maximums. Do you see the same in your research?
Wasn't part of my research, but I think it was. It's something which I have read and talked to, the three large broker firms that, particularly for ransomware going into the renewals, many carriers are now starting to put sublimits or co-insurance. In other words, they will maybe only do 50% of losses under your ransomware payment, for example, rather than 100%. So we're starting to see that. One other, I was reading through a cyber insurance policy the other day. I'm such a nerd when I realize I'm very self-aware when I say that. The structure of the policy was really interesting because it was very modular. One module dealt with network interruption and business interruption. Another module dealt with the ransomware event. Another one dealt with third-party liability. And each module had definitions and coverages and exclusions contained within. In other words, it wasn't sort of an overarching policy. What that tells me is that this carrier, and perhaps I'm attaching nefarious motives to them unfairly, but I'm not sure I'm too far wrong in saying this, that they may be pulling some of those modules out of the overall insurance policy in the future. And that's the reason why they've structured that. And they'll be able to sever certain sections without putting the overall policy for a need of a complete rewrites, because each module contains the definitions, the wording, the coverage, the extensions, the exclusions, etc.
I think that might have to do with the way that they build the towers too, because you have, if you have a $70 million policy for your aggregate limit, you have maybe 7 different carriers that are doing 10 million apiece.
Oh, yeah.
And some are covering some areas, and everybody, like you said, has their own definition. So I think that might be a reason why you're seeing that.
Yeah.
Yeah.
Yeah, no, the carrier's been hit hard by ransomware, particularly in the last 12 months. So yeah, expect to see some exclusions and co-insurance, and carriers will expect you to retain some of that risk going forward.
Right. So we have a question from Jason, and thank you very much, Sean, for yours. And his question is, you mentioned the Ponyman report, which lists several factors for reducing the cost of breaches. Did your study look at any other factors that may not be captured in those reports, specifically items that may reduce overall breach cost?
It's an interesting question. So the study was, very focused on the perceptions of cyber insurance to risk managers. Didn't really cover this area, but I'm looking at my factors for the purchase decision. I suppose that aside from, we didn't touch on silence cover that exists under property and liability policies, and that silent cover is essentially cover which is provided under, say, property policy, for example, that for cyber losses, which was never intended by the carriers, but insureds believe that they have cover under that. So that was a topic of discussion amongst the risk managers, and I guess that it does reduce the cost of breaches, if sort of indirectly.
Makes sense. So we have a question from Joe. Phil, we often hear this debate as to the paying of claims by insurers. I see strong indications that claims are, in fact, paid reliably over the last decade. My research indicates leading insurers are handling thousands of claims a year, and US carriers paid cyber claims totaling an estimated $394 million back in 2018. Do you see any indications to the contrary in your research?
So yeah, I cannot validate that number, but yeah, net diligence cyber claims studies is very well cited in the academic research. I mean, this is the interesting thing about the lack of peer-reviewed papers, is that even those that are high quality papers, well cited, will go back to industry surveys like Ponymon and net diligence. So you can, if you're doing your own research, you can certainly hang your hat on some of those, some of the surveys. I would observe that the insurance companies have had a pretty good run with cyber insurance. Their claims ratios have only been 65%. In other words, for every dollar of premium they collect, they pay 65 cents in claims. That's an extremely profitable business for them compared to, say, property, which insurance companies would be thrilled if they could get a claims ratio of 90 cents or 90%. So it's 60, 65%. So it's going to be interesting to see what the 2020 numbers look like. So in terms of cyber claims, we know it's definitely increased 2020 on previous years for all of the reasons we've talked about on this advisory board. So I would say that the claims are certainly heading northwards, as are the premiums.
Right. Thank you. Another question from Joe. Thoughts on growing IoT risk and cyber insurance? I think we can see that IoT will have a massive impact. Gartner estimates 20 billion plus devices by 2020. Cisco estimates 30 billion devices by 2025. However, since the insecurity of IoT is still vast and the risk is growing, if we just look at the examples of healthcare, we see research is finding potentially deadly vulnerabilities in dozens of devices, such as insulin pumps, X-ray equipment, CT scanners, medical refrigerators, and implantable defibrillators. Is this an opportunity that the cyber insurance industry is well adapted to, or are they still behind the curve on insuring against IoT events?
I frankly think the insurance industry is behind the curve just on their cloud exposures, let alone IoT. There was, I don't know if you attended, Ariel, but there was a session in the 2019 Advisen Cyber Conference in New York back I think October, November of 2019. And there was a session with some of the major reinsurers well, I won't name them, and someone asked them about the session was packed. It was standing room only because we wanted to hear from
I
the
was there,
reinsurers.
yeah.
Oh, you were there. If you remember, there was a question about cloud-based security,
Mhm.
and they didn't have an answer. And you could have hear
Or the pin drop.
pin drop. Yes, I think you remember that moment. It was extraordinary. So
Especially at, you've got 2,000 people in like a packed auditorium,
right.
and, and to have that level of silence was just unprecedented. Yeah, it was different.
So this is very concerning. I think the reason I mention this is that I don't think the insurance industry is well geared up technically to handle and understand how to rate and price cloud-based risk, let alone IoT risk. And
Right.
IoT, I think it was in a recent study, or maybe it was mentioned on a previous call, I realized that average hacking time for an IoT is 6 minutes. Quite extraordinary.
Exactly. And you're seeing also, and I think this may push them into getting some kind of a policy together around this, is that you're seeing regulation now coming into play. California has their IoT Data Security Act, which is, it's the beginning of something. It's pretty weak, but it's there. And what that's going to do, I think, is to drive regulation again at this technical level in digital assets, to understand what technologies you're using. And there's another initiative that's going on, which is looking at both hardware and software manufacturing and understanding what country it's made in, because there's been a lot of focus on getting rid of things that come from China. So we're going to see a lot more need to understand this detailed information. But I think you're absolutely right about, they don't even have a cloud strategy. How are they going to have an IoT strategy? So we have another question here from Jason. I would love to understand if the topic of IoT has a significant aspect covered by insurance firms. My direct experience talking to insurance carriers was that there are very few claims and even fewer with any significant amount of impact in this space. As a result, there was little concern from many of the big carriers to deal with it from a perspective of reactive or proactive. Are they seeing the same in your study? And just one other thing I'll throw in there before you answer that is, on the property side, IIoT is somewhat physical, right? So
Right.
I don't even know if they're able to, bifurcate that piece. So what are your thoughts on that?
Yeah. So if I read the cyber insurance policies correctly, IoT devices are covered as network systems and network infrastructure. So all things without providing specific guidance, you always need to understand your policy, because as I mentioned before, those exclusion clauses are vary a great deal between carriers. You need to understand the policy. So IoT would generally be covered under a cyber insurance program. I did see Zurich come out with a specific cover for manufacturing-based systems. In other words, those systems and technology which changes things like flow rates and pressure and temperature, within industrial controls, from their industrial control systems. I think that's some good innovation, from Zurich. I think FM Global's had that cover for quite some time as well. So yeah, I think that. So I haven't seen anything. IoT was not discussed specifically during my study. I think this is sort of one of the limitations of the study, which I've identified in the dissertation document itself. You really did have to sort of carve out what was going to be the focus. But certainly, perhaps another area of research. This is the thing with academic research. Sometimes the result is, well, there's more questions to be answered than the going into the initial research.
Yeah, so a couple of things on sort of following up with this, and we'll see if there's any final questions or if you want to wrap it up with a final thought. we have an IoT cyber risk paper coming out in the next 2 weeks, which we'll send to everyone, that details what you need to know in order to be able to actually protect yourself. So that will be something that we'll share with everybody. And of course, if anyone's looking to quantify limits, we're teaching that in the course, and we have the technology to do that too. So if you want more information about that, please reach out to me personally. And with that, yeah, it's a great topic. They want to know if they can get a copy of your research paper, Phil. Would you be open to that?
Yeah, I'll be happy to send out a summary, and that contains all of the relevant detail. If you want a copy of the 100-page dissertation itself, I can send you a link to ProQuest, and I think it's a nominal fee. It is under copyright, so I can't spread it around like confetti. But yeah, I think it's like $35 or something like that if you want a full copy of the dissertation.
If you want to send that to me, we will include that in the advisory, in the newsletter, and we'll send it out to everybody. So we can put a link up on the website so people can just go ahead and do that. So you don't have to bother to send it to
Perfect.
several hundred people.
Appreciate that.
Which I'm sure you've got better things to do. All right. So thanks so much, Phil. Do you have any parting thoughts? I think we've covered all the questions. Do you have any parting thoughts for folks around this area that you'd like to share?
No, I think this is a very interesting area of the insurance market, and I think as the risk evolves, so will the insurance market. I think we do see the insurance companies do struggle in trying to get their heads around cyber insurance. At the end of the day, though, it is going to be retained. I think a lot of this risk is going to be retained within organizations, which means that greater reliance on cyber risk management programs, and you really try to quantify that cyber risk. I think that's going to be critical.
Right. So if anybody wants to just do a quantification course on insurance limits, we'll be happy to put one together for folks. That could be something that would be about 3 hours worth of courses. And Meredith Schnur from Marsh is the person who teaches that course with us. So she's excellent. She will talk about the insurance policy piece of it and how to separate out the casualty and property components and the gaps, and then how to look at the exclusions. And she will also dissect it into the various components. And then we will go and put you through the quantification exercises of how to build a data exfiltration model, and that's going to be primarily tagged to your aggregate limit, how to build a ransomware sublimit, how to build a business insurance interruption sublimit, as well as privacy sublimits and credit card sublimits, which we're seeing. And you can also look at what they call dependent versus non-dependent, which is the cloud versus the on-premise, because you do have policies that are carved out like that. So thank you so much, Phil. It was a very informative session. Congratulations on an amazing accomplishment.